Welcome to the Chartered Financial Analyst Level 1 series of videos. We were discussing the topic of corporate finance and equity. Today we'll have the video number 13. This video will be a continuation of the topic of cost of capital. And today we will introduce new ideas about valuing an existing company for acquisition. That means we are targeting a company for a possible acquisition. The money will be provided by the parent and it will be invested in the subsidiary. So which cost of capital we should use to value the subsidiary? Is it the cost of capital of the parent or the cost of capital of the subsidiary? Why the question? Because there are two levels of leverage. The parent may have a leverage of 90%. That means the cost of capital will lean towards the debt. And the subsidiary may have a capital structure with very few or very small amount of leverage. That is, let us say 5% or 10%. We can't use money with a leverage of 90% in an investment that is only 5% leverage. So what we will do, we'll remove the leverage from the parent and use the leverage of the subsidiary. So we will delever the cost of capital, removing the effect of the capital structure, remove the effect of the leverage, and then we re-lever again using the capital structure of the company we are intending to acquire, that is the subsidiary company. Let us see how we do that. To understand how we are going to deal with the topic of acquiring another company that has a leverage that is different or a capital structure different from the parent, as I just mentioned, we remove the effect of the leverage and then introduce the new leverage of the subsidiary. To understand this, let us have an example or a numerical example to see how we do this. Let us assume that a parent company is going to acquire a subsidiary in another country, and we have this information available from the financial statement and from the market as a general. This is the subsidiary data, and here the parent company data. The equity is 500 for the parent and 300 smaller company. Debt is 400 and 300. If you notice that debt divide equity will give 80%, 4 divide 5 will give 80%, while 3 divide 30 will give 10%. That is 10% leverage debt to equity ratio. And here it is 80% debt to equity ratio. That means the parent company has a very high debt in its capital structure compared to a very low debt in the capital structure of the subsidiary. This poses a dilemma. How? Because the money to acquire the subsidiary is provided by the parent from this capital structure of a very high leverage. But then we are going to acquire a subsidiary that is going to generate cash in that country using capital structure that is different than the parent, with a very low risk, because financial risk, because the leverage is just 10%. The other data is the debt cost of debt in the parent 4% and in the subsidiary is 5%. Normally the debt in the subsidiary in the smaller companies will be higher than the parent, that is the bigger company, because the size has effect on the risk. The parent with a big size with low risk will attract debt cheaper than smaller companies. Tax rate in the two countries is different. In the parent 35, here is 30. Treasury bill or deposit in the bank pays 2% in the parent and 1.5% in the subsidiary. What we mean by this is the interest rate risk-free. The risk-free rate of return is 2%, 1.5%. The market return in the parent country is 8%, here is 9%, and this is the beta for the two companies. If you notice, the beta here is higher than the beta here because there is a financial risk due to very high debt. And here the financial risk is very low, the beta is very low. We need to calculate the cost of equity using the capital asset pricing model as we have seen in previous videos. Then after calculating the cost of equity for both, then we go for the weighted average cost of capital for both companies. But we are going to pose a question: which weighted average cost of capital we are going to use to discount the expected future cash flow from the subsidiary we intend or contemplate to acquire? This is the main theme of this video: how to answer this question. Which weighted average cost of capital we are going to use to value the subsidiary? Let us bring the two formula for the weighted average cost of capital and the CAPM or the capital asset pricing model to calculate the cost of equity, and here the cost of the company debt, indebtedness, and the equity together. To make it simpler, let us bring back the data here so that the calculation will be easier to follow. We will start by the parent company's cost of equity, which is 2% the risk-free rate of return in the parent country, 2% treasury bill, plus the beta, which is 1.5, sorry, where is beta? 1.5 in the parent country, beta, market return minus risk-free rate of return. The market return here is 8 minus risk-free rate of return, we'll get the cost of equity. We will use this cost of equity here to get the weighted average cost of capital for the parent. This is the equity divide the total finance, which is the debt plus equity. Debt plus equity, 900. Plus cost of debt, which is 4%, as I just mentioned. Then the weight of the debt. This is the debt, divide both finances, that is the equity plus debt. And this is 1 minus 35%, that is the tax rate, 1 minus T. So we get the weighted average cost of capital of this figure. Similarly, we are going to calculate the cost of equity for the subsidiary, which is the 1.5% treasury bill risk-free rate of return time beta 0.9, which is lower than this beta because of very low leverage. Market return minus risk-free rate of return, together we call it market premium, risk premium over and above the risk-free rate of return. The risk premium is the market return minus the risk-free rate of return. Here we have the market return of the subsidiary, 9%, that is a 9, minus risk-free rate of return is 1.5, as we have just seen in the subsidiary treasury bill. We get this cost of equity. Similarly, we will use this cost of equity in the formula for calculating the weight of cost of average, which is this one, 8.25 cost of equity times the weight of the equity, 300. We are talking about subsidiary. Divide both finance, 330, plus cost of debt, 5% debt in the subsidiary, and then this is the weight of the debt, which is 30, divide both, 330. Tax is 30%, 1 minus tax is 70. We get a weighted average cost of capital of this figure. Now again, let us go back to the main question of this video: which weighted average cost of capital we are going to use, of the parent or of the subsidiary? To answer this question, as I mentioned in the second slide, that we need to remove the effect of the high leverage and then use the low leverage to calculate new weighted average cost of capital. Neither this and nor this. How to remove the leverage of the parent and introduce the leverage of the subsidiary in the calculation? We will see this now in this equation. As I just mentioned, that the money generated or the cash generated will be from the subsidiary. 5 years, 10 years, we estimate the expected cash flow in the future. It will be generated by a company that has a very low leverage, 10%. That is the subsidiary. But the fund is used or provided by a very high leverage parent company. So which weighted average cost of capital we are going to use to discount these future cash flows expected to be generated from the subsidiary, so that we get the net present value of the subsidiary and then offer that price to the owner of the subsidiary and tell them that we are willing to buy it according to the net present value calculation. We need to use a formula first to delever or to remove the leverage of the parent, beta unlevered. We need to remove the effect of the leverage from the beta, which is already very high, 1.5 in the parent, as we have just seen in the previous slide, while the beta in the very low leverage company with very low debt, that is a subsidiary, was 0.9. So we need to unlever, to remove the leverage effect of the parent by bringing the beta of the parent which with the leverage and then divide 1 minus TAC, debt divide equity, which will be very high debt here. And then we re-lever using the leverage of the subsidiary. After we get the beta unlevered, we multiply by this data from the subsidiary to get the beta with the leverage of the subsidiary, bringing in the beta of the parent that has provided the money, and then we use that to discount the future cash flows. Let us continue our discussion and find out the answer. We are going to delever or remove the effect of the leverage from the beta of the parent unlevered, and this is the data we are bringing from the parent company figures. Unlevering the parent, that is the beta with the leverage 1.5, as we have seen, very high, and then we plug the figures here as normal. Debt divide equity of the parent. High debt 400 divide 500. Equity will get debt to equity ratio of 0.8. Debt to equity ratio of 0.8, and then we get a new beta that is unlevered. We call it acid beta. Why we call it acid beta? That calculate the risk of using the assets of the parent, regardless of the capital structure, regardless of how these assets are financed. Are they financed with more equity and less debt, or the other way around? Is irrelevant now, because we have unlevered. That means we have removed the effect of the leverage, and now we have a very clean beta without any regard to the capital structure. But when we go there to the subsidiary, we need to bring in the low leverage of that subsidiary to the equation, so that we get beta with leverage associated with the subsidiary. To do that, if you remember, this is the equation. Beta with the leverage of the subsidiary is equal beta without the leverage, unlevered, time, as usual, debt divide equity. If the debt is very high and the equity is very low, we get a very high BL. But since the debt we know is very small, this fraction will be very small, so it will be less than the 1.5. Let us bring the data of the subsidiary. Beta unlevered, we have just calculated without leverage, is 0.98 times 1 minus T, 70, because we are talking now about the subsidiary. In that country, the tax was 30%. 1 minus 30% will give 0.7 time 10. 10 is the debt divided equity. See, very small debt to equity compared to very high debt to equity of 0.8. The 10 is 30 divided 300. 30 debt divided 300 equity will give 0.8. Now, this is the beta introducing the leverage of the subsidiary. If you notice the three figures, 1.5 is very high because the parent is very highly leveraged, 0.8. The beta without leverage is very small. Now, we introduce the leverage of subsidiary, it goes more than 0.9 to 1.05 because of very small debt to equity ratio. The beta just went higher. But if this, let us say, close to 1, then we'll go back to 1.5. If the debt is higher, that means debt divided equity is very high, then this will be more than 1.5. Equally, if there is no debt, let us assume no debt at all, then we should ideally get this. Because if this is 0, then we get 0, 0, 0, we end up with the same 98%, 100% equity finance. Then we are going to calculate again the cost of equity using the new re-levered data, so the beta loaded with the leverage level of the subsidiary time the market return in the subsidiary country minus risk-free rate of return, which is 1.5%, we get cost of equity totally different than previous calculation, 9.4%. Then we use that cost of equity to calculate the weighted average cost of capital, 0.95 divide time equity divide both equity and debt of the subsidiary, plus 0.5, which is the cost of debt in the subsidiary, the debt level, which is the debt weight. This is why we call it weighted average. The weight of the debt is the debt divided debt plus equity. And this is 1 minus tax. Tax is 70%. Then we get a figure of 0.887. That is the weighted average cost of capital we are going to use to discount the future expected cash flow of the subsidiary to get the net present value of that future cash flow, which will be the value of the subsidiary. This is how we value possible candidate companies for acquisition. In the next video, video number 14, we are having the first topic to add the risk related to the country. Normally, we assume or estimate the debt and the beta using similar companies from other countries, for example, the US market. We get the beta of similar companies. But then we need to adjust for risk specific to the country where we are living or where we are going to acquire the subsidiary, and we are going to use a method called sovereign yield spread. Spread is the difference between two figures. Bid-ask spread is the difference between the ask price and the bid price of a stock or any commodity. There is a spread in the yield of bonds issued by the government. We call it sovereign because it is issued by the government. In the USA, if it is 5%, we expect in other developing country will be more than 5 because the risk is higher. So the spread is always a factor we are going to consider. We'll see this in video number 14. Also, we are going to calculate the cost of equity in the real life, because in real life, after using the capital asset pricing model and the estimated beta, we adjust that figure in real life in certain cases. We will look into that into the video number 14. As usual, please do not forget to subscribe to the channel. Thank you.